Just yesterday, I made a video about the reopening of the Strait of Hormuz, a moment that offered a brief glimmer of hope for the global oil markets. But today, news breaks that it's closed again. A critical choke point for nearly 20% of the world's oil supply has been severed once more. And the implications are far-reaching. Hello everyone, I'm John A.G., and welcome back to The Wealth Reactor. Today, we're diving into a scenario that could send shockwaves through the global economy, the closure of the Strait of Hormuz. Again, the world barely had time to breathe after the recent reopening, and now we're faced with the reality of another shutdown. This isn't just an oil issue, it's an economic crisis unfolding before our eyes. Stay with me as we break down why this disruption could have catastrophic consequences for the global oil markets and the broader economy. The Strait of Hormuz is a lifeline for the global oil supply, with nearly 20% of the world's oil passing through this narrow passage between Iran and the Arabian Peninsula. If this choke point is closed, whether by political conflict, military intervention, or another disruption, the ramifications will be immediate and profound. Why is this so critical? Oil is the backbone of the global economy. It powers industries, fuels transportation, and drives economies worldwide. A disruption in this supply chain could send oil prices soaring to $200 per barrel or more. The result would be an explosive rise in inflation, higher production costs, and a serious slowdown in economic growth, likely sending several nations into recession. But the fallout doesn't stop with oil prices. The entire global financial market would feel the pressure. Investors would flock to safe haven assets like gold and U.S. treasuries, destabilizing markets. Countries, particularly in Europe and Asia, that depend heavily on oil imports, would be forced to face a crisis of staggering proportions. Prices would surge, supply chains would buckle, and the cost of living would rise sharply, crippling households and industries alike. Beyond the immediate effects, there are long-term ramifications. As countries scramble to find alternative energy solutions, the push toward renewable energy will accelerate. But this transition won't be smooth. As industries adjust, economies will face growing pains. The geopolitical instability could further complicate the global landscape, leaving the world economy vulnerable to future shocks. The sudden closure of the Strait of Hormuz would trigger an immediate surge in oil prices, with the potential for a dramatic and destabilizing impact on global markets. Imagine waking up to find that one of the most crucial oil passageways has been severed, and 20% of the world's oil supply is suddenly cut off. The ripple effects would be swift and severe, with oil prices potentially skyrocketing to over $200 per barrel. This sharp increase would not be confined to the energy sector. It would quickly infiltrate nearly every aspect of the global economy. For businesses, industries, and consumers alike, this sudden surge in oil prices would be felt in every corner of the economy, leading to a cascading series of disruptions. At the forefront, fuel prices would soar, and the immediate effects would be seen at gas stations, where consumers would face unprecedented price hikes. But it's not just about what's paid at the pump. This rise in oil prices would send shockwaves through the transportation sector. Airlines would raise ticket prices to account for higher fuel costs, while shipping companies would struggle to manage the rising expenses of transporting goods. As goods become more expensive to move, the cost of production for a wide range of industries would increase dramatically. From the manufacturing of goods to the agriculture sector, virtually every business would feel the burden of rising energy costs. The true extent of this price surge would go beyond inflationary pressures. It would ripple through the entire global supply chain. Countries highly dependent on oil imports, such as those in Europe and Asia, would experience severe economic strain, as rising fuel costs would cripple industries and raise the cost of living for their citizens. This disruption would trigger an economic slowdown, stalling growth and pushing some economies to the brink of recession. The interconnected nature of global trade means that a single disruption in oil supply could bring economies to a standstill. The sudden closure of the Strait of Hormuz would create a storm of instability in the global financial markets, causing immediate and far-reaching effects. As one of the most vital shipping lanes for oil, its disruption would send oil prices surging, triggering a cascade of financial consequences. Investors, sensing the volatility ahead, would scramble for safety, shifting their portfolios into safe haven assets such as U.S. treasuries, gold, or even cryptocurrencies. The demand for these secure assets would skyrocket, pushing their prices higher and exacerbating the instability in the broader market. This would lead to a dramatic sell-off in riskier assets like equities and corporate bonds, particularly in sectors highly dependent on stable energy prices such as transportation, logistics, and manufacturing. Financial markets thrive on predictability, and the sudden uncertainty created by the closure would undermine investor confidence across the globe. As oil prices skyrocket, inflationary pressures would mount, putting further strain on economies already grappling with slow growth and rising debt. Central banks would face a difficult balancing act, raising interest rates to combat inflation while managing the risk of pushing economies into deeper recessions. This financial turbulence would also affect the foreign exchange markets. With oil prices in flux, the US dollar, traditionally seen as a safe haven currency, would likely experience a surge in demand, strengthening relative to other currencies. However, this would create additional challenges for countries with dollar-denominated debt, amplifying the debt burden of emerging markets. As the markets react to the closure, the banking sector would be under immense pressure. Banks exposed to the energy sector could see an increase in loan defaults as oil-dependent companies struggle to meet their financial obligations. Meanwhile, personal debtors in consumer-facing economies would feel the squeeze as the cost of living increases, leading to higher levels of consumer defaults. The tightening of credit would follow, making it more difficult for businesses to secure financing, which would further choke economic growth and exacerbate the financial crisis. The sudden closure of the Strait of Hormuz would have profound inflationary consequences, impacting economies worldwide and creating a ripple effect that extends far beyond the energy sector. As oil prices surge, the immediate result would be a rise in transportation costs, affecting everything from shipping goods to fueling personal vehicles. With oil being the lifeblood of industries such as aviation, logistics, and manufacturing, the increased costs would be passed on to consumers in the form of higher prices for goods and services. This would put significant pressure on household budgets, particularly in countries that rely heavily on imported oil. For many economies, already burdened by high debt levels and sluggish growth, this would be a tipping point, driving inflation to levels not seen in years. The surge in energy costs would push the price of virtually every commodity higher, from food to raw materials. This increase in the cost of production would send shockwaves through global supply chains, leading to delays and shortages. As manufacturers face higher input costs, they would either absorb the extra costs or pass them on to consumers. The latter would likely be the dominant approach, further exacerbating inflation and shrinking the purchasing power of households. In nations already struggling with income inequality, this inflationary spike would disproportionately affect lower income groups, deepening the gap between the wealthy and the rest of society. Central banks would be faced with a difficult challenge: how to balance the rising inflation with the need to sustain economic growth. Raising interest rates to combat inflation could stifle investment and push economies further into recession. Conversely, maintaining lower rates to support growth could fuel even higher inflation, creating a vicious cycle that would be difficult to escape. In this environment, consumer confidence would erode and spending would decline, further impeding economic recovery. The closure of the Strait of Hormuz would not only send shockwaves through oil prices and inflation, but also ignite a geopolitical and economic crisis that would destabilize global trade. As one of the most crucial oil transit routes, its disruption would amplify tensions across the Middle East, leading to a cascading effect on international relations and global commerce. With approximately 20% of the world's oil passing through this narrow waterway, countries heavily reliant on these supplies, such as those in Europe and Asia, would face not only economic strain but also the potential for diplomatic and military conflict. Nations that rely on stable access to oil would be forced to navigate a complex web of negotiations, alliances, and potential military interventions, all while the risk of escalation looms large. This geopolitical instability would likely manifest in trade disruptions beyond oil alone. The flow of goods and services would slow as shipping routes are altered, and nations scramble to secure alternative sources of energy and trade routes. Increased military presence in the region would not only drive up security costs, but could also divert resources from vital industries, further stalling economic progress. Countries seeking to mitigate the impact of the closure would likely look for alternative energy sources or emergency solutions, but these efforts would take time to implement, leaving global economies vulnerable in the meantime. As international tension rises, economies would also feel the strain of a fractured global supply chain. Critical goods, from raw materials to finished products, would become more expensive and harder to obtain. Companies in sectors like manufacturing, electronics, and consumer goods would face delays in production, leading to shortages in essential products. This disruption would create a ripple effect, as industries adjust to higher costs, reduced inventory, and an uncertain economic future. The closure would not only challenge energy markets, but would expose the fragile interconnectedness of global trade, pushing governments, businesses, and consumers into a prolonged period of uncertainty and adaptation. In the end, the closure of the Strait of Hormuz isn't just an oil problem. It's a stark reminder of how fragile our interconnected systems are. A single disruption in this key waterway could unravel decades of economic stability and disrupt the entire fabric of global trade and security. So, as we watch this developing situation, it's clear that we must prepare for the ripple effects of this closure. The global economy is walking a razor's edge. This has been John A.G. with the Wealth Reactor. Stay informed, stay prepared, and subscribe for more insights into the forces shaping our world. Until next time, keep your eyes on the critical events that will define the future of global economics.